A loan is a financial arrangement in which a lender provides money or resources to a borrower, who in turn agrees to repay the loan amount or resources, along with any interest or fees within a specified period. In doing so, the borrower incurs a debt which they must pay back within a given period of time. Usually, loans are issued out by banks, microfinance institutions, and money lenders. When applying for a loan, some institutions may require you to show proof of your cash flow, like a salary or business income. For example, if you opt to get a salary loan from a bank, you will be required to have things like a letter of undertaking from your employer, as well as your current payslip. This gives the lender an understanding of your capacity and ability to pay back their money. For some loans, the lending institution like a bank or a microfinance may require you to provide collateral. Collateral is security that the lending institutions takes a hold of when they are lending you money and return to you as soon as you're done paying the loan. This can be a land title or a logbook of a car. Security protects the lender from losing their money. So, if you fail to pay back the loan, they can use the security to recover their money. A lender may not require security for loans like salary loans. However, it is important to be sure you can afford the interest rates of the loan you want to take. Now, let's look at some features of a loan. Loan size. Not everyone can apply and get a loan of any amount they want. Financial institutions and lenders will calculate your loan size first. That is, the highest amount of money you can request for. This is based on your source and amount of income and the possibility of you paying back the loan. For example, someone earning 500,000 shillings per month wouldn't be given a loan of 100 million shillings over a period of 1 year, since the risk of them defaulting is high. Rather, the lender will recommend a loan size more suitable to that borrower's income. Loan term. This is the period of time that the borrower has to use the borrowed money and repay it fully. Some borrowers can choose to take out a short-term loan of a week or month, while others can choose to pay back after a year or more. Depending on the loan term, you will need to calculate the interest you would have to pay back on the loan. The loan term period is agreed upon by the lender and the borrower. Interest rate. Interest is the price you pay for borrowing money. It's the additional money you have to pay to the person or financial institution that lends you money. This is normally expressed as a percentage of the amount you have borrowed. Fees. Fees are additional costs incurred by a borrower to meet loan requirements. For example, application, processing, and insurance fees. It is very important to understand and calculate all the fees you will need to pay before considering taking out a loan. Grace period. A grace period allows a borrower to delay payment for a short period of time beyond the due date. During this period, no late fees are charged, and a delay cannot result in default or the cancellation of the loan or contract. As you look for the best lender, try to find out which one offers a grace period in case you cannot meet your repayment obligation in time. Repayment schedule. Every lender has a repayment schedule. Some will require you to pay back a portion every month, and others, based on the loan term, will require a lump sum after a certain period. It is vital to know the repayment schedule the lender is offering so you can know what your total cost will be and plan effectively on how to pay back the money. Many people borrow money to make more money. For example, if you're opening a shop, you may decide to take out a loan to buy stock with the aim of paying back the loan after selling that stock. Others borrow to take part in farming, and again, upon selling their produce, they repay the loan. When borrowing to invest, it is very important to have a clear plan of how the money will be used and to have a realistic repayment plan. Some people borrow in case they have an emergency, like an accident. If you own a car and get into an accident, you may need extra money to fix the car or pay your medical bills. Unplanned events can force you to take out a loan, but it is still equally important to ensure you can pay back the money to the lender on time. People also borrow money to purchase an item for which they do not have enough money for, such as land. If you have a job and you want to own land, you may not be able to do so immediately. However, getting a salary loan can enable you to purchase the land and pay back later, as the lender deducts money from your salary. As you consider investing, attending to an emergency, or purchasing an item, it is important to understand the difference between using your own money and borrowed money. When you use your own money, you are free of debts and/or pressure from owing money. It could take longer to meet your needs when using your own money, but through savings, this can still be achieved. If you used borrowed money, you get a greater lump sum right away, which is quicker than saving little by little. Please note, a loan costs money and can be expensive if you default on it. A loan also comes with obligations to the borrower, including paying back with interest. So, before taking out a loan, it's best to evaluate if you can save and use your own money, or, if absolutely necessary, take the loan and pay it back in time. So, before taking out any loan, first ensure you understand all the aspects that are associated with it, so you can make a clear and informed decision.
NSSF, a better life.